The US dollar just surged to its highest level in months. And silver dropped nearly 6% in a single session. Billions of dollars in market value shifted in hours. Traders panicked. Headlines blamed yields. Analysts blamed geopolitics. But here's the real question no one is slowing down to answer. Is this the beginning of a dollar dominance cycle, or the setup for silver's next structural breakout? OG John here. This isn't hype. This isn't fear. This is a macro battlefield analysis. And today we're dissecting one of the most important financial conflicts unfolding right now, silver versus the US dollar. Here's what matters. I don't sell signals, I don't run a hedge fund, and I'm not here to push narratives. Everything we discuss is publicly verifiable. You can check the dollar index, you can check COMEX inventories, you can check treasury yields. My job is simple. Connect the dots logically and show you what the data implies beneath the surface. Now let's step into what just happened. Over the last 48 hours, the US dollar index pushed sharply higher. Treasury yields climbed, liquidity tightened, and silver, which had been pressing toward psychological resistance near $95, reversed aggressively. This wasn't random. When the dollar strengthens rapidly, commodities priced in dollars become more expensive globally. That reduces international demand at the margin. At the same time, rising yields increase the opportunity cost of holding non-yielding assets like silver. Institutions react fast to that math. Macro funds rotate capital toward dollar-denominated assets. Risk desks reduce commodity exposure. Leverage traders unwind positions. Liquidity thins, volatility expands, and silver, which is thinner and more volatile than gold, exaggerates the move. Now let's move into the data cascade because this is where clarity forms. Silver's recent high approached the mid-90s. The rejection occurred near a major resistance zone that has capped rallies before. Open interest on COMEX had expanded significantly during the rally, suggesting speculative participation increased. When the dollar surged, those leveraged longs were vulnerable. At the same time, US 10-year Treasury yields pushed higher. The dollar index broke above a short-term consolidation structure. That triggered algorithmic buying of the dollar and systematic selling of metals. The gold-silver ratio widened. That's critical. When gold outperforms silver during stress, it tells you capital is prioritizing monetary safety over industrial speculation. COMEX warehouse inventories remain structurally tight compared to multi-year averages. Physical premiums in certain retail channels have not collapsed, even with paper price weakness. That divergence is subtle, but it matters. Industrial demand remains structurally elevated. Solar panel manufacturing continues to consume large volumes of silver. Electrification trends haven't paused, but industrial demand doesn't move price minute to minute. Liquidity does, and liquidity right now favors the dollar. Here's another layer. The dollar strength isn't just random appreciation, it's tied to relative growth expectations and rate differentials. When global uncertainty rises, capital flows into US assets. When bond yields rise relative to foreign yields, currency demand follows. This creates a feedback loop. Stronger dollar pressures commodities. Commodity weakness reduces inflation pressure. Lower inflation expectations support real yields. Higher real yields support the dollar further. That loop can persist longer than retail traders expect. Now, this is where we split the audience. If you are a long-term physical silver holder, your framework must be different. You're not trading weekly volatility. You're thinking in cycles. You're thinking in terms of monetary debasement, structural deficits, and systemic risk. For you, short-term dollar strength is noise within a larger macro narrative. But if you are a short-term trader, this environment demands precision. Dollar momentum matters. Yield direction matters. Technical levels matter. Silver breaking below support levels can trigger additional algorithmic selling. Volatility cuts both ways. Two different mindsets, two different strategies. This is where things get interesting. Because while the paper market reacted violently to dollar strength, the physical market hasn't shown the same stress signals. COMEX registered inventories are not exploding higher. Physical coin premiums in some regions remain sticky. Large wholesale bars are not flooding the market. That suggests the selling pressure is concentrated in futures positioning rather than a collapse in underlying demand. And here's the deeper layer. Institutional positioning data over recent months showed increased speculative participation during silver's rally. When crowded trades unwind, price overshoots. But overshoots don't automatically equal trend reversals. In fact, some of the largest structural rallies in silver historically began after violent paper market flushes. Now zoom out. The global macro backdrop is not simple. Government debt levels remain historically elevated. The US fiscal trajectory continues expanding deficits. Geopolitical tensions remain unresolved in multiple regions. Energy markets remain sensitive. Supply chains are not fully normalized. At the same time, central banks globally have been increasing gold reserves for years. Silver is not accumulated at the same scale by central banks, but it rides the broader precious metals sentiment cycle. Industrial demand is another wildcard. Solar installations continue scaling. Electric vehicles require silver in electronics. AI infrastructure demands energy. which demands electrification, which demands conductive metals. This isn't a conspiracy thesis, it's supply chain mathematics. If industrial demand remains firm while mine supply growth remains constrained, structural deficits can form even if short-term prices fluctuate violently. But now let's address the bearish case directly, because ignoring the bearish case destroys credibility. If the dollar continues strengthening due to persistent yield advantages, silver could remain under pressure. If real yields climb further, non-yielding assets lose relative appeal. If global growth slows meaningfully, industrial demand expectations could soften. If speculative interest fades after volatility spikes, liquidity could thin further. And here's another risk. If silver fails to reclaim broken support levels and those levels convert into resistance, technical traders may press short positions. Momentum funds follow price. They do not predict it. Also, we must acknowledge that silver's volatility makes it vulnerable to exaggerated downside moves in risk-off environments. During acute liquidity squeezes, investors sell what they can, not necessarily what they want. Those are real risks. Now let's synthesize everything. The dollar's surge is currently the dominant force in short-term pricing. Liquidity favors the dollar. Yields support the dollar. Algorithms are aligned with dollar momentum. Silver, being both a monetary and industrial metal, sits in the crossfire. But structurally, silver's supply constraints and industrial relevance haven't disappeared. Physical market signals are not showing systemic breakdown. Instead, we're observing a paper-driven volatility event amplified by macro momentum. This isn't random. This is what happens when macro forces collide with leveraged positioning. So who wins this battle? In the very short term, the dollar has momentum. Momentum matters. Respect it. But over longer cycles, currencies are policy tools. They expand. They inflate. They are managed. Silver is finite. It is mined. It is consumed. It is conductive. It is industrial. The timeline determines the winner. Now let's bring clarity with 3 key takeaways. First, the current market reality. Dollar strength and rising yields are pressuring silver in the short term. Liquidity flows are driving volatility. Technical levels matter right now. Second, what is changing structurally? Physical supply constraints and industrial demand trends remain intact. Paper market volatility does not automatically equal structural weakness. Third, what to watch next. Monitor the dollar index trend. Watch real yields. Observe whether silver reclaims prior support zones. Track COMEX inventory trends and physical premiums. If divergence between paper price and physical tightness widens, that's a signal worth paying attention to. Here's what matters. Markets are not emotional. They are mechanical. Liquidity moves first. Narratives follow. If you're watching from the United States, Europe, Asia, or anywhere globally, I want you to comment your country and your silver price outlook for the next 3 months, not guesses. Your reasoning. Let's build a serious macro discussion community here on OG John Analysis. Share this video with someone who tracks currencies seriously, not someone chasing headlines, someone who understands that currency strength and commodity weakness are 2 sides of the same system. And if you want consistent, logic-driven breakdowns without hype cycles or panic narratives, follow OG John Analysis. This channel is built for independent thinkers. One final note. This is financial education, not investment advice. Always do your own research. Verify the data, challenge assumptions, including mine. Because in markets, blind agreement is expensive. Silver versus the dollar is not a one-day fight. It's a cycle battle shaped by policy, liquidity, and structural supply. Invest with logic, not emotion. I'll see you in the next analysis.